Good afternoon, everyone. I'm T3 Live Editor-in-Chief John Darcy here to bring you the daily recap. So yesterday we talked about how tech showed a little bit of a pulse after some really intense selling that we'd seen over the last several days. And today, I guess you could say the pulse got a little bit stronger without the body completely being able to leave the hospital and get out of intensive care, or whatever analogy you want to use. But you did see some momentum stocks get in on the act. The whole market did rally, and you also saw a red dog reversal in the S&P, but it was definitely constructive from a trading perspective to see some of those momentum stocks that have been beaten down so much get in on the act, join that rally, and provide traders a little bit of momentum to get back involved to the long side. But first, we'll just take a look at the chart of the S&P, because from a technical perspective, you can see we put in a very clear red dog reversal today. And after big two-day sell-off in the S&P, coming into major support here, or intermediate term support at least, here at this upper level, this was a natural spot to look for some type of reversal, as we've gotten a little bit oversold, and that's what we got. We got a trade down through the previous day's low, close back above. You know, it's not a big igniting candlestick that tells you we're going to zoom back to highs or anything like that, but it is evidence that downside momentum has slowed a little bit, and maybe we could get a 1.5, 2, maybe even 3-day bounce, but we'll obviously judge that as we go. Given the magnitude of some of the selling we saw in high beta and tech names, some people might argue that this maybe is just the eye of the storm, maybe some calm before some more downside, but we'll judge that, like I said, one day at a time. And I don't think right now is like I talked about this morning, time to really be super aggressive. It's time to dip your toe in. If you were able to identify some longs and catch some bounces today, then you probably had to do it pretty early and be pretty aggressive off the open. But overall, it's okay to not be involved during these choppy periods and wait for more calculated type setups. If you're one of those that's leaning short, maybe wait for another day or so for the market to bounce a little bit, work off some of that oversold condition, and then maybe head lower. But we'll take a look at the Qs as well, because the Qs are the ones that had really gotten hit hard and were the real red flag for the market, as they didn't even get close to back to highs, whereas the S&P was back at highs. And the Qs broke down really hard on Friday, continued to the downside yesterday, but like I said, showed a little bit of sign of a pulse, closed off of its lows, although it wasn't able to do a red dog reversal yesterday. Today opened slightly higher and then pushed a little bit higher during the session to repair some of that damage, but still not the most convincing, tenacious bounce in the world, and still has a lot left to prove if this is going to be anything more than an oversold bounce. But just running through a few tech names that were able to bounce today and help the Nasdaq bounce. Netflix found support at its 200-day yesterday thanks to an upgrade, and then today was able to push higher, get back near its 8-day moving average. It's going to have to get back above that 8-day moving average before it starts to really fix that technical composure, but at least provided a bounce today because it was very oversold. Google as well had broken down out of this bear flag pattern. A big breakdown on Friday, showed a little bit of sign of life yesterday, and then today opened higher and didn't look back into its 8-day. Same as Netflix. It's going to have to get back above that 8-day to really improve its composure and amount to anything more than just an oversold bounce. And you take a look at Amazon. Amazon is below its 200-day, but got a decent bounce today. Yahoo, another one. I know Mark Sperling is long this, got a decent bounce, did close off of its highs a little bit, which is not ideal. Now you have to see whether this 200-day becomes resistance. It used to be support. Now you got to see if it becomes resistance, or whether Yahoo can at least get back up into the 8-day and then try to get back above the 8-day. But a lot to prove here still for Yahoo. And then eBay was one of the bigger bouncers today. Closed on its lows yesterday, signaling potentially that this was one of the weaker tech stocks out there, but was actually able to gap up pretty big and then accelerate back above its 200-day moving average, even closed just above its 8-day moving average. So repairing some of the damage there. And you look on the macro chart of eBay, that pattern still looks pretty intact that Scott talked about in his 2014 outlook on a monthly chart. This is just an upper level base that eBay has been forming since the rally that started in 2009, ended about end of 2012, and basically for the last year and a half has been forming this upper level base. So on a macro level, just continue to watch that pattern in eBay. And then even besides those notable high beta tech names, you saw several individual stocks that I highlighted in last night's Off the Charts, for example, and last night's daily recap, today's morning call even. I mentioned a few of them that I really liked. And at the top of that list, I also tweeted about it yesterday, if you follow me on Twitter, was my favorite setup in the market was FSLR. And this is one that Mark and I collaborate on his trade idea of the week every week, and we came up with FSLR. It was one of the stocks that was really holding up best. We didn't want to identify a short setup on Monday given how oversold we were or became on Friday, so we looked to potentially look for something that had been showing a lot of relative strength and maybe forming an upper level base, and that's exactly what you've seen with FSLR. Even in tech had been showing a lot of relative strength, and even within the solars had been showing a lot of relative strength. You look at TAN, the solar ETF, then you look at FSLR. FSLR, big igniting move back on March 19th, and sort of just forming a really nice upper level base up here. You know, a little bit sloppy, not the tightest base that you'd like to see, but given the power of that igniting move, it can't really be blamed, and it never closed below its 8-day moving average until yesterday, or I guess it did on 2 days prior to that as well, but still above the 21-day and still in this upper level flag was the most important thing to note yesterday. And what I talked about in yesterday's recap in today's morning call, that I thought yesterday's sell-off was actually a great opportunity for an aggressive entry into First Solar in the bottom end of that flag. You know, a lot of times momentum traders, technical traders look to buy as a stock breaks the upper end of a flag, and yes, you can get some momentum on those types of breaks, but I think oftentimes if you look to buy in the bottom end of a flag, if you trust a pattern based on what you see, I think you can get a much better entry, and that obviously held true today as First Solar rallied almost 8% from the bottom end of that flag to near the top end of that flag. And now if it can get above this pivot high here at 74.84, then it could really take off. And the price target that we put on Mark Sperling's trade idea of the week for FSLR was around 82 to 85, which is the magnitude of the inbound move, is the way you judge a measured move on a bull flag pattern like this. So you talk about a stock rallying from around 55 up to around 70, 75. You measure a 15 or so point move from the breakout, and that gets you up to 80, 85 area. So definitely looks very healthy to me. Might need a little bit of sideways action at the upper end of this flag now after a big igniting move today, but First Solar is one that I would continue to watch long and should be near the front of your long radar. And OVTI is one that I also tweeted about and also talked about in yesterday's recap and today's morning call, is one that I thought had a great pattern. It's not, it's sort of a mid-level pattern when you look at it in a macro sense. On the daily chart, it looks great. On the weekly chart, yeah, it is a little bit of a mid-level pattern, but beggars can't be choosers right now, and if you find a good sort of intermediate term setup, I think you have to take advantage of it. And then you look on the daily chart here, you can see a nice gap up after bouncing at the beginning of February, held at least half of that gap to form sort of a mid-upper level base here, and then yesterday showed extreme relative strength to get back above its 8-day, and then in kind, it provided some follow-through today to break to highs. This is another one that may be a little bit overbought after these two big up days, but one that with some sideways action I think can continue higher. If you're involved already and have some good prices, I think you can let it run. I think this one has some more upside in it. Another one that hasn't really gone yet, but you've probably heard me talk about it before, is GTAT. It's been lethargic the last 2 days, so some traders with short attention spans might discard this from their watch list, but I really think it's one that is holding up well considering some of the carnage that we've seen in these other speculative type names. GTAT just barely below its 21-day here, a little bit choppy here after a huge run that we've seen so far in 2014, as it's basically doubled this year, or slightly less than doubled. But I do think if the market is able to sustain any sort of bounce, and even if it's not, I think GTAT is enough separated and doesn't have as much correlation in the market as some other stocks that momentum traders might look to trade. I think this is one that all in all holding up well, digesting that big rally that we saw since the beginning of February, and I think could eventually head higher. And also within tech, Chinese internet stocks were some of the strongest bouncers today. VIPS is an example. Yesterday, week, 4 really strong down days there to break below its 8 and 21-day moving average, but gap and go to the upside today to get back in touching distance with those 8 and 21-day moving averages, basically touching both of them. So if it can continue higher here, I think the Chinese internets overall bounced a little bit more ferociously than some other names in tech. You also look at Baidu, one of the bigger names in this group, found support at its 200-day moving average, it looks like. So we'll have to see if that continues to hold for Baidu. But some other smaller names in the group also bounced really strong, but there's so many of them, I'm not going to go through all of them. We can talk about it in the virtual trading floor tomorrow. And while the tech stocks did get on the act of this bounce, the flight to value type sectors did continue, which helped the S&P stage that red dog reversal and just continued the positive trends that we've seen in those areas. So you take a look at something like XLU, really strong day today. It looked like it wanted to be weak a little bit early, but bounced really impressively, which is not surprising given the continued strength that we've seen in bonds. Bonds and the XLUs are sort of like proxies for each other, given their profile, pretty steady yields, but not a ton of price appreciation potential in terms of trading the ETF and stuff like that. But both of those really strong, and the XLU just sort of trades in kind with the TLT and bonds. And then you look at XLP, which I talked about in the morning call this morning. They were strong as well, continuing higher above the 8-day moving average. You look at something like Procter & Gamble, which is my favorite among the consumer staple stocks, both from a long-term value perspective and technically looking a lot better right now. A little bit weak early, but also closed on its highs and broke out of this mid-level base here. So yeah, I think you could see Procter & Gamble continue higher. And then biotechs. Biotechs are looking a little bit iffy still here. While tech was able to bounce today and sort of participate in the rally, biotechs are not really bouncing too well. Yesterday they found some footing and showed some relative strength. You'd have liked to have seen them continue to the upside today and continue to show relative strength, but instead you got some very mixed action there, which you're inclined to get in the biotech sector given all the news and stuff that surrounds different drug approvals and things like that. Something like Gilead, for example, has all kinds of negative press about how expensive one of their drugs is. There's some backlash from the people who are buying this drug and regulators and stuff like that regarding the price of their new drug, and that's weighing on it a little bit. Looks like it's going to retest the 200-day moving average, so it'll be very important for its composure whether or not it holds that pivot low, holds that 200-day moving average. So that'll be something to watch. BIIB was strong pre-market, but actually came back in prior, in the last 30 minutes before the open, and then was weak during the session. So that's not what you'd like to see after some pre-market strength for BIIB. Another one that looks like after engulfing yesterday's body of yesterday's candlestick, looked like it might want to retest its 200-day moving average as well. So not the most healthy action in biotech. And the XLF, talk about not very healthy action. The XLF has not looked good at all right now. Yes, it was able to finish around the flat line today and close off of its lows, but like I've talked about, you're really seeing a case of the haves and the have-nots in this group, and a few names are really weighing on this ETF and just the sector as a whole. Look at Goldman Sachs, third day of really harsh selling, continuation at the downside after breaking down below what you could call a head and shoulders type pattern, or just a inverse cup and handle, whatever you want to call it, but broke this key pivot support and just continues to cascade lower. Closed slightly off its lows, but given the fact that the market bounced today, not what you'd like to see in Goldman Sachs. Citigroup also not quite as weak as Goldman today, but again, wasn't able to participate in the bounce at all. On the flip side, you have something like Wells Fargo, just now testing its 21-day and was able to stage a red dog reversal today and looks like it wants to hold higher. And then you also look at the credit cards. These are not banks, obviously, but they're in the financial group. Visa, look at these trends that these credit cards were in for years. Since Visa IPO'd in 2009 or in 2008, had a little bit of a tough start to its public life, but then since then has just been in a steady uptrend and almost, you could say, going parabolic, and then you're seeing it maybe break this accelerated uptrend in the same way something like IBM broke an accelerated uptrend in the last couple of years and broke down a little bit. But I guess it couldn't continue forever for these credit cards, and just another thing to take note of, you can see it's breaking below its 8-month moving average here on the monthly chart. So these credit cards looking a little weaker, and you could look at the same thing on MasterCard, pretty similar type setup. On the monthly, a king and queen, which usually leads to more downside, and that's what we're seeing in MasterCard. Basic material stocks caught a little bit of a bid today. I know some people were watching those. They have heavy short interest, so they're often on momentum traders' radar screens. CLF, for example, yesterday closed on the lows, but then gapped up today, continued higher. It's above its 8 and 21-day, and now within spitting distance of its 200-day again. To really improve its composure, it's going to have to climb back above that 200-day and challenge some of these pivots here around 23 and change. So we'll see if that leads to anything. It's sort of been in a steady uptrend since the beginning of March, has CLF, so it's improving there. WLT, a coal play, bouncing a little bit today, closed off of its high. Some people thought it might squeeze and close the rest of this gap. It didn't quite get there. It sort of has a tendency to put in tails like that historically. So we'll have to see it close back above the 21-day, close the rest of that gap, see if it can squeeze. It does have a really heavy short interest. And then finally, 3D printing. I sent out a tweet today about VJet. VJet is a company that people were just bidding this thing higher. It was a $70 stock soon after its IPO last November. And the quarter preceding this big run-up, the stock sold 3 3D printers total that accounted for all of their revenue, and they weren't even permanent sales. They were leases, and they've since been returned to the company. So this company was built on a house of cards, I guess you could say, and as you can see, has pulled in sharply. This big decline came on the heels of a bearish report from Citron, the infamous, short sellers or whatever you want to call them, people who write bearish reports on stocks, and hasn't been able to recover from that. And then today issued another secondary offering for insiders to sell more of their stock, despite the fact that it's pulled off this much. That's a huge red flag, and I think this one could even break these IPO lows around 20 and head lower. The 3D printing group valuations on these got completely out of whack, and everyone loves to talk about how stocks can grow into their valuations. Valuations don't matter. That narrative is all good and well until the day comes when the reckoning happens and these stocks get absolutely crushed, and that's what's happened in VJet. And so it's the type of sector that I don't like to get involved in because of how speculative and how much of a house of cards it is built on, but VJet's just the latest example of that. Other little 3D printing names, you see XO&E getting more than cut in half from its highs, back even from the beginning of this year. It was almost an $80 stock last summer, now trading down around 30. That's not healthy action, to say the least. And then DDD is one of the more mature 3D printing stocks, but even it has a murky-looking technical future, and it just got ahead of itself in terms of valuation. It's gotten cut in half as well. And today looked like it might want to bounce, but then put in a little bit of a topping tail, and basically showing that it's not ready and might need to bleed lower before it's oversold enough to get a bounce. So 3D printing group, just an example of how valuations don't matter until they do, until people start talking about them and using them as a reason to sell. And the air is definitely coming out of this one, and I think bubble is definitely a term that could be applied to 3D printers and without being unfair. So again, sort of, in my opinion, I think right now you have to either tighten your time frame, take 1.5, 2-day trades. I know Scott's been popping in and out of the VTF talking about that same type of strategy. That's more of his approach, to tighten his time frame in times like this. That's more of Mark Sperling's approach in times like this when things are difficult. Take your trades, work on getting back to green, booking profits when we do get a bounce, if that's what you're looking for. Or you could take the approach that you could widen your time frame, look to play a little bit more value-oriented stocks, and just abide by the rotation that we're seeing, and just stretch your time frame out and ignore the noise that we're seeing, gyrations in stocks that are holding up pretty well. That's more of my approach, and I think both of them, depending on the way you approach the market, are sound advice right now, rather than trying to take big swing trading bets and catch falling knives and looking to play snapbacks. I think your risk outweighs your reward a lot of times when you try to do that during volatile periods in the market, and I think that's the source of a lot of frustration for traders right now. But tomorrow we'll see if that pulse with tech continues to get stronger. We'll see if those value sectors continue higher. But overall, I think some people are going to be looking to short some bounces right now, given the magnitude of the selling that we saw over the last few days. But we just have to separate the haves from the have-nots. A lower correlation, I think, in stocks is good. It's good for traders to be able to identify relative strength and not just trade everything based on the indices. So I think separate a little bit your view from the indices of your view of individual stocks, and I think that's the best approach right now. But I'll be back here again with Brittany tomorrow morning for the morning call. I'll be on in the recap tomorrow afternoon, and then we can all welcome Scott back on Thursday. It'll be good to have him back. Tough to come up with new things to talk about every single day. I feel like sometimes I get a little bit repetitive, but I feel like if you're not repetitive, if you don't harp on the same ideas on a day in, day out basis, you run the risk of being a little bit too erratic and a little bit too manic in your ideas. And I like to formulate theses that apply not just on a 1 or 2 day basis. I like to formulate theses that apply on multi-month basis or even longer than that, and identify those trends and ride those trends as long as you can. So it'd be good to have Scott back. It's been great to be in front of the camera for a few days, but I'm happy to see the spotlight. Anyways, this has been John Darcy here for your daily recap. See you back here tomorrow morning.